Have you heard the saying that it's better to kill two birds with one stone? Well, in the world of real estate, essentially what that means is you are reaping the rewards of two or more properties just by purchasing one home. This is done by investing in small multifamily properties like a duplex, for example. Small multifamily properties are those that have 2 to 4 units with 1 unit per floor. They can be apartments, condos, townhomes, or any other type of residence where there are multiple units under one roof. Now, I promise they are perfect for investors who want to get their feet wet in real estate and want to make money without a lot of risk. And the best thing? Small multifamily properties are often less expensive than single-family dwellings, so you can invest with less money up front. That's why in this video, not only will I walk you through how to invest in small multifamily properties step by step, but if you stay until the end, you'll learn how to evaluate properties so that you can be sure that your investment is successful and profitable. So without wasting any more time, here are the 7 steps in investing in small multifamily properties. Number 1, do your research. First and foremost, you need to know what the heck you're getting into and how much it will cost you. This is especially true if you're new to investing. You'll want to know what the market is like in your area, how much rent people are paying for similar properties, and whether there are any local regulations or restrictions that could affect how much money you can make off your investment property. One way of researching is to talk to people who already own small multifamily properties in your area. They will let you know what their expenses were and how much they made off of them. They'll also probably have recommendations on good contractors and handymen they've worked with before, which can save you a ton of time and money along the way. A good rule of thumb is this: the more you know about what makes a good investment, the better equipped you'll be to find one that meets your needs and goals. Number 2, check your resources. Basically, when you're investing in small multifamily properties, it's important to make sure your budget is in order before you start. I mean, after all, if you don't know what you can afford, how will you know what to look for? If you're looking for a property that will cost $100,000 and you have only $50,000 saved up, then you're basically starting off on the wrong foot. It's important to make sure that the amount of money you have to put toward a new investment is something that fits in with your overall financial goals. You want to be able to afford and maintain the property and make sure that it will continue to generate enough revenue for you to pay off any loans associated with the purchase. If you have too much debt already or don't have enough extra income to cover the expenses, it's probably not a good idea for you to invest in small multifamily properties right now. If this is the case for you, then it may be better for you to wait until your financial situation improves before starting this process. Number 3, consult an expert. You've probably heard this before, but it's worth repeating. If you are considering investing in small multifamily properties, consult an expert. An experienced real estate agent can help you find the right property and steer clear of common mistakes that inexperienced investors may make. They can also assist in understanding the market and financial options. The truth is, even if you've had experience with other types of real estate investing, buying small multifamily properties can be tricky. There are special considerations when it comes to finding financing and getting approval for loans. You also need to know how much money to expect from each property, which ones will be more profitable, and how to manage them effectively. All of these questions are hard enough on their own, but when there are multiple properties involved, things can get really complicated really quickly. That's why consulting an expert can help take some of the stress out of your decision-making process. You'll have someone who knows exactly what they're doing, so you can focus on making sure everything else goes smoothly. Now, here's a fact for you. The typical ROI of a small multifamily property can range between 10 to 12%. This translates to an annual return of $10,000 to $12,000 for every $100,000 invested. How do you like that? Keep watching because in a minute, I will tell you how to evaluate a property so that you can get the most out of it. But first, give this video a thumbs up and subscribe to this channel so it can be spread to more people. Number 4, find the right location. Finding the right location is essential to investing in small multifamily properties. It's important because the location will determine the success of your investment. A good location will allow you to rent out your property quickly and at a high price, while a bad one could lead to empty apartments and lost money. Just hear me out. If you're looking for an investment that will pay off quickly and consistently, then small multifamily properties are probably your best bet. The reason is simple. They're easier to manage than a single family home. They require less maintenance and repair, and they don't require as much time or effort on your part. But if you want to make sure that you can get the most out of your investment, then it's important that you find an area where these properties are likely to be profitable for years to come. Trust me, you need to find the right location in order for your properties to be profitable. You can have an amazing property with great tenants, but if it's in the wrong area, then you won't see any returns on your investment. Number 5. Evaluate the property and its features. Evaluating your property is an essential part of investing in small multifamily properties. It allows you to determine whether or not the property is worth buying and if it will be profitable. It's crucial that you know what you're getting into, so you can make an informed decision about whether or not to purchase a certain property. Here are some questions to ask yourself when evaluating a small multifamily property. Number 1. What is a neighborhood like? Is it safe? Is it close to transit? Are there any other amenities nearby, such as grocery stores or restaurants? Number 2. Condition. How old are the appliances? What condition are they in? Are there any major repairs that need to be done before tenants move in? Number 3. Amenities. Is there a laundry room on site? How much will my monthly utility bill be? If there isn't a laundry room on site, where can I go nearby for laundry services? It's also important to look at how the property is laid out and whether it has enough space for tenants to live comfortably. The last thing you want is for your tenants to feel cramped or uncomfortable because there isn't enough space for them to move around freely. Number 6. Analyze the costs. In investing, it's all about the numbers, but what do those numbers really mean, and how can you use them to make better decisions? Understanding the cost of operating a small multifamily property is crucial to making sure you are getting the most bang for your buck. You may be thinking, I'm just going to buy a small multifamily property, rent it out, and make money. But look, there's more to it than that. In fact, understanding how much it costs to operate a small multifamily property could help you make better decisions about what properties to buy and when to sell them. Here are some costs you will come across. First, purchase price. This is the most important cost. You'll need to have enough cash on hand to make the purchase and have enough left over to cover any repairs or renovations needed. Second, insurance. You should also consider getting insurance for your investment property, such as renter's insurance or casualty insurance, which covers damages caused by fire or theft, among other things. Third, maintenance. The cost of investing in small multifamily properties also includes maintenance costs, such as fixing broken appliances or repairing leaks in the roof when they occur, so make sure you have enough savings set aside before investing. Number 7, put pen to paper. You've looked at all the numbers, you've made sure you have money to invest, and you've done your due diligence on the property itself. Now it's time to put a pen on the paper. This can be a nerve-wracking time, but if you're prepared, then you'll be able to enjoy the next steps in your investment journey. Remember, this can be a bit intimidating, but it's also very exciting. You've made it this far, and you're about to bring your investment home. It's just a matter of signing on the dotted line, and then celebrating with some champagne. Don't forget to subscribe to the channel, and in fact, if you want to learn exactly how to buy your first property with little to no down payment, you gotta watch this video next where I'll walk you step by step on how to get it done. I'll see you in the next one.